Assalamu alaikum friends, welcome to day 2 of AAA revision series. Sorry for the delay. First of all, there was a gap between day 1 and day 2. The reason is I was quite busy with other revision series that were going on, the AA and AFM and then SBR. So I'm dealing with 3 more subjects. So I was not able to upload a video on advanced audit and assurance for day 2. Day 2 and day 3 are pending. But don't worry, I promise that I will finish day 2 and day 3 before your exam gets over. Okay. So let us start with day 2. This is the continuation of day 1. If you haven't watched day 1, please do watch day 1 because day 2 is the continuation of it. So in day 1, we have covered the first 6 topics, and day 2, we are going to cover the remaining 6 topics, which is planning, materiality, and assessing of risk, assessing the risk of misstatement. 8, group and transnational audits, very important, okay? Because in AAA, we are going to cover group auditing very extensively, which was not covered in your AA. Evidence, completion, reporting, and audit-related services. So let us start with the first topic, which is planning, materiality, and the risk of misstatement. What are we going to cover here? Here we are going to cover the audit planning, risk assessment procedure, and materiality. Now, what is audit planning? And why do we need audit planning? The reason we need audit planning is because without plan, you cannot do anything. You don't know where you are, what is your progress, where you have to, when you have to achieve it. Are you achieving your objective on time or not? So audit is also similar like that. Like any other aspect of your life where you have to plan and take a decision, audit also you have to plan. Okay, no auditor goes in an organization first day and starts auditing without a proper plan and strategy. Every auditor will be having a strategy and an audit plan. You need to know what the audit strategy and what the audit plan includes. Okay, so audit strategy includes scope. What is the scope of the audit? What are your limitations and where can you go? What areas can you audit? For example, engagement characteristics. Then we have reporting objectives. To whom should you report? How you have to report? Significant engagement factor. There are some significant engagement factor that you have to take into consideration. And this, remember, this planning and strategy are done these are the first stages of your audit. Preliminary activity results. Then we have the resources needed, whether you have the staff that you need, whether they have the expertise or not, whether you have the skills and knowledge in the sector where you are auditing. Then we have timing of when to deploy the resources. Very important. In the strategy, this comes. How are you going to use your resources and at what time of the audit? Then management, direction, and supervision. Okay, it helps you to manage, direct, and supervise the resources. And you have to attend meetings and all. How many meetings you have to attend? The reviews that you have to go through. Now let us go to the plan. What does the plan includes? Nature, timing, and extent of the risk assessment procedure. Okay. Then again, nature, timing, and extent of the further audit procedures. Sometimes you might have to do further audit procedures, especially for risky entities which are engaged in risky activities. One example is entities which are heavily using financial instruments, derivatives. That's a very complex area, so you need a lot of knowledge on that. Technical knowledge is required, and also subject, and you have to use a lot of estimations there. Okay, professional judgment is required in this area, so it's more risky. Hence, audit procedures you have to increase in this area. Some entity, by nature, they are less risky, so you can reduce your audit procedures for that. Now, what does this include? It includes what audit procedures are you going to do if you have to do some additional audit procedures. Then, who should do them? Okay, who is going to do this audit procedure? How much should be done? There's a limit to everything. You cannot do however much you want, okay? The reason why you are doing this audit procedure is to collect audit evidence, okay? Once you get that audit evidence and it justifies your opinion, you don't have to do more audit procedures are not required in that same item. When the work should be done, okay, in the plan this is also told. When are you going to carry out the work? Next, other necessary procedures, okay? It's not, the detail is not given, but if necessary procedures are required, it will be there in your plan. Then risk assessment. Risk assessment also you do it in the planning stage while you're planning. So in order to comply with ISA, International Standard of Auditing, auditors are required to design procedures to reduce audit risk. You have to design the procedure where you can reduce the audit risk to an acceptable level if the audit risk is high already. Okay, and what does it include? Audit risk. What is audit risk? Audit risk is a risk that auditor is unable to give an audit opinion. He's giving an inappropriate audit opinion. Okay, the reason is this could be influenced by two further risk categories. There are two risk categories that you have to know, which is risk of material misstatement. So audit risk compromises of two risks. One is risk of material misstatement. That's why he's giving inappropriate audit opinion. Okay, the risk that the financial statements are misstated. And the other risk is detection risk, where the audit procedures fail to detect material misstatement. First one is financial statement is misstated. Okay, that's a risk. Inherent risks are there. No matter what you do, some risk will remain there. Second one, auditors are trying to detect, but they are not able to detect the material misstatement. They fail to detect. Okay, that is known as detection risk. Then we have two types of risk. Okay, risk of material misstatement is a factor of two things. That means your financial statements can be materially misstated due to two risks. One is inherent risk. Inherent risk is risk that fraud or error occurs in the first instance. That means no matter what you do, risk will be there due to the nature of it, due to the industry which they are at. So there's an inherent risk that remains. No matter what you do, no matter whatever the system you have, you can have the best system still, your financial statements can be materially misstated. Because there are so many, in some areas you have to use a lot of significant judgments are required, you know. So those areas are more, chances are there that mistakes can happen in those areas. Next is control risk. You're trying to control, okay? You're trying to detect fraud and error, but that control is failing. The control that client is using, that control fails to prevent or detect fraud and error. Inherent is before putting any control. You are not using any control. Before that, the risk is there. Control risk after you have implemented a control. What is the risk? Okay. So whenever your financial statement is misstated, materially misstated, it could be due to these two reasons. One is inherent risk, the other one is control risk. Okay. And you have, this is the role of the auditor. They have to understand the client entity and its environment. Why? To assess risk, to see the risk that the client is exposed to. They have to study these things. Relevant industry, regulatory, and other external factors auditors need to study. They need to understand this. Which industry their client is at. For example, your client is a bank, is in the banking industry. Bank industries are heavily regulated. You have to know the rules and regulations of it. So it's not just the auditing standards that you have to know. You have to know the the rules and regulations related to the bank as well, because your client is in that firm. Next, because then it is highly risky. You have to know that. Okay, nature of the entity. You have to know the nature of your entity. It includes its operation. You have to know your entity's operation, your client's operation, its ownership and governance structure. That IT is separate. Okay, it is together. It's its ownership and governance structure. For example, how it is owned, who are the shareholders, governance structure, how it is governed. Do they have non-executive director? Do they have audit committee? Proper audit committee with independent non-executive director in the audit committee? Do they have a remuneration committee? Do they have a risk committee? Do they have enough non-executive director on the board? So all these are governance structure. Do they have strong internal control? Type of investment that it makes, okay? The way it is structured and financed, their capital structure, how much of debt they are taking while financing. Because if they are taking too much of debt, it becomes, the gearing ratio increases, hence it becomes very risky. Then entity selection and application of accounting policies, how the entities are applying the accounting policies. They are selecting and applying the accounting policies. That also you have to understand. Okay, next, what is the entity's objective, their strategies, any related business risk auditor needs to know. And measurement and review of the entity's financial performance as well as the internal control that is relevant to the audit. Auditor needs to have an understanding of all this to minimize the risk to an acceptable level, because this can have an impact on the audit risk as well. What is the meaning of audit risk? Auditors are giving inappropriate audit opinion. So if you are having a better understanding of your client, you will be giving a more appropriate opinion, right? That's why you need to understand your entity and all. This is not optional. If you want, you study. No, it's compulsory that you have to know your client, understand these areas. Next, we are moving towards business risk. Remember, in your AAA, the latest paper which I've done a paper a few days back. I've uploaded, especially in question number 1. If you remember, I think it was June 2021 paper, the latest paper. I did question number 1, and there I saw the first question asked business risk, audit risk. And I think it was for some 20 marks or something. I don't remember the number of marks, but it was some 10 marks or 20 marks. So this shows the importance of you knowing the business risk. In AA, in your audit and assurance, business risk was not so much of importance. It was only audit risk. But in AAA, you have to know both the business risk as well as audit risk. And they are not same. You have to differentiate them, okay? You will be given in the scenario and you need to identify what is the business risk out of this and what is audit risk, okay? And this question can come as a 10 marks or 20 marks. So you need to prepare well on this area. Okay, what is business risk? Business risk means all those factors that threatens the client's ability to meet their objective. For example, they are unable to meet profit, or they are suffering, their cash flows are suffering. That is business risk. Now, these are an important part of inherent risk. Remember, business risk is something which is inherent. No matter whatever you do, whatever the control you put, inherent risk will be there. And this can have an impact on the financial statements. Remember, it's not only the audit risk that can make a financial statement misstated. Business risk also can have an impact. For example, the most important thing from your exam's point of view, you should know, business risk focuses on the impact to the profit or the cash flow of the company. Two things. If anything in your scenario that is given to you in the exam, if it has an impact on the profit or cash flow, it's a business risk. That's how you identify. Okay. Now, let us go through some examples of audit risk versus business risk. Very important table. This can save you a lot, especially when you're going through textbooks and all. Rather than knowing each and everything, just know few examples between audit risk and business risk. This shall help you to answer better relating to business risk and audit risk. Okay. So first one, I'm going one by one. Major customer in financial difficulty, unable to pay their debt. Out of this is a business risk also as well as audit risk also, but the risks are different. Okay. First, let me explain the business risk. Then I will go to audit risk. The reason why, because business risk, I told it will impact your profit or cash flow. It's easy. So first, let me finish the business risk. Then I will explain the audit risk. Relating to the first item, that is customer is unable to pay. What is the risk? Bad debt. It's a bad debt, right? Your bad debt will increase. So if your bad debt increases, in your statement of profit and loss, your profit falls down. So your profit is affected, right? It's a business risk. Coming to the audit risk. Receivable. Okay. Receivable may be overstated if bad days have not been written off. If you don't reduce your bad days, your receivable, your debtor in the statement of financial position will be overstated. So the word that you have to see for audit risk, what is overstated, what is understated. When it comes to business risk, it is about profit, impact on profit and cash. When it comes to audit risk, it is about overstated and understated. Okay. So if you, and mostly in the statement of financial position, okay. So receivable is overstated. That means it is a material misstatement. Why? Because major customer, look at the word major customer. So major customer means receivable will be of a huge amount. That's why it is a material misstatement. Okay, receivable. Coming to the second point, company purchases goods from overseas. So what is the business risk? Exchange rate issue, right? When you're purchasing, okay, purchase can become more expensive if the exchange rate goes against you, if it's unfavorable. Hence, it will reduce your profit, because where do you record purchases? In the statement of profit and loss, right? So your profit will go down. If your purchases increases in the statement of profit and loss, please try to visualize your profit will go down. So it's a business risk because profit is affected. Coming to audit risk. Purchases may be misstated if the transactions are not translated to an appropriate exchange rate. You have to translate. If you're not translating that foreign currency to your home currency, purchases can be overstated, misstated. We cannot say understated or overstated because it can be either way depending on the exchange rate, but it is misstated, not the correct amount. Even the payable. Remember, audit risk can have an impact on two places. One is in the statement of financial position, the other one is on the transaction, that is statement of profit and loss. So purchases is the transaction and balance is payable. Payable may be misstated. Payable also will be misstated if it's on credit. If not revalued using the year-end exchange rate, remember every year you have to reevaluate at the year exchange rate at the year end. If you don't do it, that will be misstated as well. Hence, it's an audit risk. Coming to the third, changes in laws and regulations affecting the company. How it's business risk? Because if you are not complying with the changes in law, you have to pay a fine. So that fine will reduce your profit. It's a cost, it's an expense. Coming to the audit risk, there is a risk of unrecorded liabilities. Why? If you're not complying, it's a liability, it's a provision for you. Unrecorded liability. You have not recorded that liability. You are liable to pay that. You are liable to comply with it. You are liable to pay the amount of fees that you are incurring or the penalty if you're not complying. So if liabilities are not recorded, misstated. You see? Coming to the fourth one, sales have decreased significantly and the company is closing a number of sites. So if sales fall, profit will fall and it will also impact your cash flow. Okay? Because you're not receiving cash from the customer. Sales are decreasing. Coming to the audit risk. How it can have an impact on the audit risk? Asset values may be overstated due to impairment. Asset values may be overstated. For example, in the asset, you can write cash. You're receiving cash. It is overstated, but you're actually not receiving that much of cash now. It is overstated. Asset. So cash is in the asset only. Even your receivable also comes under asset. That also will be overstated now. But you should reduce it because the sale is decreasing. Okay? So it's an audit risk. Anything understated, overstated, it's on audit risk. Because if anything is understated or overstated means it is misstated. Coming to next. Okay. So this were the 4 areas. Now let us come to the risk assessment procedure. So auditors should do what when it comes to risk assessment procedure? Number 1, they should obtain an understanding of the accounting as well as the internal control system. Okay, when it comes to risk assessment procedure, because this should be sufficient, that understanding, to plan the audit and develop an effective audit approach. Number 2, first they should obtain an understanding. Second, they also have to use their professional judgment to assess the component of the audit risk and also to design the audit procedure so that they can reduce the risk to an acceptably low level. Okay, then what are the risk assessment procedure? There are 3 risk assessment procedure. 1, ask directly from the management. Okay, inquiries of management and others within the entity. Number 1. Number 2, do analytical procedure. You can calculate ratios and all to see the trend and all. Then third, observe and inspect. Observation and inspection. So through this, these are your risk assessment procedure. Okay. Then materiality. So from risk assessment, we are coming to materiality. What is materiality? According to ISA 320, definition of materiality is information is material if its omission or misstatement could influence the decision of the user who is basing their decision on the financial statements. FS is financial statements. Okay. Next, three things you have to take care of when it comes to materiality. Number one, materiality should be considered in relation to what? Number one, financial statement as a whole. So when you're setting the materiality level, you have to set it in mind with financial statements as a whole. Number two, unique circumstances of the business. Every business is different. What is material for one company might not be material for another company. Okay. So you have to take that also into consideration. And third, what is the informational requirement of the user? Okay. Then we have and ultimately an area of judgment. Okay, this is an area of judgment you require, but for your exams point of view, you can use this figure to understand what is materiality and what is not materiality. For sales or revenue, 0.5%. Anything above 0.5% is considered material. Anything below 0.5% is not material. Okay, for your exam, you can use this. Coming to profit before tax, 5%. Okay, above 5% material, below 5% not material. Total asset above 1% material, below 1% non-material. So from for your exam AAA, you can use this figure. But in reality, the figures might change because you are using a judgment over here to say what is material, what is not material, the range that you are giving. Then we are coming to performance materiality. How does the auditor establishes performance materiality? Performance materiality is an amount that is lower than overall materiality. Okay, definitely it should be. The reason why we are doing is so that we can minimize the risk of material misstatement from the total of aggregate. When we are aggregating all the mistakes, the total should be less than the amount that you have set for the financial statements as a whole. That's why we are setting this performance materiality. And also to assess with testing samples. It helps with testing samples. And finally, to reduce the risk that misstatement in aggregate is material, reduces that risk. When you are aggregating small misstatement, that total should not be greater than the materiality that you have set for the financial statements as a whole. Remember that. That's why we are setting this performance materiality at an amount lower than the overall materiality. Okay. Now we are coming to the response to the risk assessment. See, knowing the risk, having the risk procedure in place is not enough. If you don't know how to respond to the risk, you have to respond also. Are you going to accept? Are you going to minimize? Are you going to reduce or transfer? Are you going to eliminate the risk? What are you going to do? So, the purpose of performing the risk assessment is to allow the auditor to modify their detection risk. That means you have to modify. Auditors have to change their detection risk now. How are you going to do that? How are you going to modify their detection risk? Examples are allocating complex or risky areas to suitable experienced and competent staff. Remember these points you can use in your exam also. Okay, response to risk assessment. In order to reduce that detection risk, what are you going to do? Put more experienced staff in those areas which is very risky and complex for anyone to understand. Not everyone is able to deal with complex and risky area. You need very experienced and competent staff. So put them. Second, placing more or less reliance on system and control. If your system is good, control is good, you can place more reliance. If it's not good, you cannot put more reliance. Okay, you have to reduce your reliance on it. Third, volume. You are changing the volume of substantive procedures that are performed. Especially for those areas which is risky, you have to perform more substantive procedures are required. So accordingly, you will change. Okay. Changing the sample size. You can increase the sample size so that you can reduce the risk. Okay, because having a bigger sample size is always considered good, because it is a good representation of the population, wider population, rather than having only small sample size. Then performing more or less substantive analytical procedure, so that more or less depends on the situation. Okay, then consulting external experts on technically complex matters. Sometimes you might have to call on a technical expert in that field so that you can reduce the risk. So these are some responses to risk assessment, how you can reduce the risk. Okay, detection risk, remember, because auditors can only change one risk, that is detection risk. There are three types of risk: inherent risk, control risk, detection risk. Auditors cannot control inherent and control risk, that is not in the hand of the auditor, but they can modify, they can manipulate detection risk, they can reduce the detection risk. How? By following this steps: changing the sample size, putting more experienced staff in the risk area, like this. Okay, now, oh yes, one more is there. You have changed the timing, frequency, and nature of review procedure. For example, you have to review more frequently if you see that it's more risky. Okay, if something is more risky, you change the timing. Now you will be doing more reviews and more frequently. And nature also. If it was not detailed, now you are going to do a detailed review to reduce the risk. Professional skepticism. This is a skill that auditor needs to have. Okay. That is an attitude that includes a questioning mind. You're always questioning. You're not accepting anything on the face of it. Whatever the management comes and tells you, you're not going to accept as it is. Okay? Because no one is 100% honest. You have to have that 1% doubt in your mind. And you have to challenge the assumption of the management. So you have to have professional skepticism you need to follow throughout the audit. Especially when it comes to uh, audit evidence. You have to critically assess that audit evidence, whether it is true or not, how true it is, how much can you rely on that audit evidence. Okay, next, this requires auditors to be alert to what? Audit evidence that contradicts other audit evidence. Okay, if one audit evidence is not going in line with the other audit evidence, you need to question, you need to be more alert, because it needs to be in line with each other. Okay, next, information that brings into question the reliability of audit evidence. If such information comes in your attention, okay, that is bring a question into the reliability of audit evidence, that audit evidence is not so reliable, then you need to be more alert. Auditors need to change. They might need to collect more evidence from other sources rather than that source only. For example, you are using a management representation, you are inquiring the management that they are not involved into any fraud and all, and they are writing it also, giving a written representation that they are not involved into any fraud. But later you come to know some information came in your attention that says that management is also involved in the fraud. Then there is no use of you asking the auditor again or inquiring. You have to find some other audit evidence. You might have to go to external sources and gather the audit evidence, because the reliability is questioned now when you if you inquire the management. Next, conditions that indicate fraud. I've given you the example. Fourth, circumstances that need more additional audit procedure. You need to be more alert. So that's it from the exams focus. These are the questions from your exam kit that you need to do. Okay, the list is given. You can take a picture. I'm going to the next one, which is topic 8, group and transnational audits. So we have finished planning, materiality, and risk assessment. Now we are moving towards group and transnational audit. Here we are going to cover treatment of groups. How do you treat groups? Group accounts. Regulatory requirements of accounting for groups is different, okay, compared to individual audit or joint audit. Special consideration. So let us go to the treatment of groups. Group is treated as a single entity in accounting terms. Okay, remember this. But in law, in legal terms, it is a collection of separate legal entities that is making a group. Remember this two treatment of groups in accounting terms versus in law. Okay, now let us go to acceptance as a group auditor. Remember, there are two types of auditor when it comes to group accounting. One is group auditor, the other one is known as component auditor. Group auditor is the one who is going to take care of the group as a whole. All the subsidiaries will be falling in, he will be auditing all the subsidiaries and the parent. It's a group auditor. Okay, so remember, accepting as a group auditor, okay, that does not mean that the normal acceptance consideration you should not take into the picture. You should take those also into the picture. These are in addition now you have to take. And what are the acceptance considerations? What are the things that you need to consider before accepting an engagement? I have explained this in day one, so you can check my video on day one relating to that. This, the one which I'm going to cover now, are addition to that, relating to group auditor only. Okay, whether you are going to accept or reject the role of the group auditor. So you must consider these things. Number one, whether sufficient appropriate audit evidence can reasonably be expected to be obtained in relation to the consolidation process. Can you receive sufficient appropriate audit evidence that is relating to the consolidation process? If you expect that, reasonably expect to receive it, then it is better to accept as a group audit. Okay, and also you need financial information of the component of the group. Component means all the subsidiaries, joint ventures, everything. Second, where component auditors are involved, the engagement partner shall evaluate whether the group engagement team will be able to be involved in the work of the component audits or not. Okay, so group engagement team, whether they can be involved in the work of the component auditor or not. Because if the group auditor, if they cannot be involved with the component auditor, then it's no use of you accepting as a group auditor. You have to get involved with the component auditor at some stage. Okay, whether reliance can be placed on the component auditor's work or not, group auditor should be able to place reliance on the component auditor's work. Then the materiality of the portion of the group not audited by them. What is the materiality of the portion of the group not audited by them? Them means the component auditor. Understanding of the group. You need to have an understanding of the group before you accept as a group auditor. Not everyone can be, not every auditor can be a group auditor. Remember that you have to have some more special, specific skills. Okay, it is more complex also in nature. So you should have the understanding of the group as well as the component and their environment also. Earlier, when you were a local the auditor in your home country, right, you are limited to just one entity, individual entity. You just had to need to understand the environment of your one entity only. Now you're a group auditor. You need to understand the environment of each of the component of the group. And we don't know how many components are there. There could be 10 components, 20 components, 20 subsidiaries, 10 subsidiaries. We don't know. Okay. So you need to have an understanding of all those environment. Then any other risk identified which affect the group and its financial statements. Risk. If it affects the group, you need to have understanding of it. Acceptance as a component auditor. Okay. Coming to the component auditor, they will look these things before accepting appointment. Number one, whether they are independent of the parent and the component companies. They need to be independent of the parent as well as the component companies of the subsidiaries also. And they need to comply with ethical requirements applying to the group audit. Next, we have special skills. I've told you, you need special skills, whether they have the special skills or not. And are they competent enough to perform this kind of work? Remember, component auditor is a very extensive work is required in this field, as well as a group auditor. Group auditor is more, in fact. Okay, you need to be highly competent enough to work in this field. Then whether they have an understanding of the audit standards. Auditing standards for the group audit are different. There are some more auditing standards which are relevant only to the group audit. You need to have an understanding of those auditing standards as well and need to comply with them. Then whether they have an understanding of relevant financial reporting framework which is applicable to the group. Okay, group accounting and all. Whether they can comply with the group audit team instructions including the deadline. because group will submit to audit report only on one day only. So they have to work around the deadline. Whether they are willing to have the group auditor be involved in their work. Are they allowing the group auditor to be involved in their work? And evaluate, they need to evaluate that group auditor as well before relying on that group audit purposes. Before relying on it for the group audit purposes, okay? So if these things are satisfied, component auditor accepts the appointment, okay? Group accounts. What does it include? So group accounts involve consolidation adjustments. Make sure that you have a very good understanding of consolidation, group accounting, standards related to group accounting from your SBR knowledge. Okay. For example, IFRS 3, which is business combination. IFRS 10, which is consolidation. Then what else is there? IS 28, associate. IFRS 11, joint arrangements. Then we have IS 7 for group statement of cash flows. Then we have IS 21 for group foreign currency. So these are some additional standards that we have relating to group. Next, relevant accounting standards must be complied with. Relevant accounting standard means relating to group. And subsidiaries may be audited by firms other than parent company auditor. Okay. Next. It is the group auditor's responsibility to review the work of the component auditors. Every group auditor have to review the work of their component auditor. Why? Because no part of the audit opinion can be delegated by the group auditor. Group auditor is the one who is going to give the audit opinion. He cannot delegate that to anyone else. He cannot delegate this to the component auditor. Component auditor will not give the audit opinion for the group as a whole. It is the group auditor's job, and he cannot delegate it also. It's not they are giving audit opinion part by part. That part of the audit opinion is given by this component auditor. Part of the audit opinion is given by that component auditor, and part of it is given by the group auditor. It's not like that. That's why it is the group auditor's responsibility that they have to review the work of the component auditor, because they need to rely on that component auditor's work. Before they rely, they have to review the work also, whether it is up to the standard or not. Are they complying with the standards or not? Next, group auditor. They normally send a consolidation questionnaire to each of the subsidiaries, requesting information on two things. One is accounting policy. What are their accounting policy? Because we know that every subsidiary, if they are in different country, they might be using different accounting policies. That's why questionnaire is sent. Next, accounting details that are needed for consolidation. Then, group auditors review of component auditors work includes. So when they are reviewing the component auditors work, what does it include exactly? It includes accounting policies. You are reviewing the accounting policies for uniformity, because you want to be sure that you are using one accounting policy and is uniform across the group. Okay. Consideration of materiality of amounts involved. You are looking at the material. Is it material? The amount that component auditor has given, is it material enough to be included? Then you include it. Then, considering whether all material areas are covered or not by the component auditor. And you also need to look at the competence of the component auditor. How much experience do they have? Do they have the knowledge? Do they have the required skill? Then there are some risks. Remember, to group accounting, there are some risks to prepare those group accounts. Okay, some problems of auditing the foreign subsidiary. Number one, geographical location. If they are too far, it's hard. You cannot physically see the location. You cannot physically observe the employees working there, right? You cannot observe the stock. So all those things you cannot do. Some of the audit procedure you have to cut down because of the problem due to geographical location. Number two, different accounting policies may be used. Yes, every country might use different accounting policies. Language problem is there. Fourth, translation of foreign currency amounts is required. Okay. Now we are moving towards the regulatory requirements for group accounts. Auditors should ensure investments are properly classified. That means subsidiary should be classified as subsidiary, associate should be classified as associate, JV, that is joint venture, should be classified as joint venture. Okay. You have to see their nature and also whether they are in line with the accounting as well as the legal guidelines. And what are the main areas of consideration? Main areas of consideration are this. If accounting policies are not uniform, then consolidation adjustments are required. You have to adjust your consolidation. Intercompany transaction. Intercompany. That means between the parent and the subsidiary. Parent is selling subsidiary, subsidiary is giving a loan to parent. This is known as intercompany transaction. If this happens, and also if there is any item in transit, it requires a consolidation adjustments, because we know that any intercompany transaction, whether sale, profit, balances, eliminated on consolidation. Okay. Then intercompany guaranteed loan should be disclosed when you're giving a loan. For example, parent is giving a loan to the subsidiary. It's known as intercompany loan because they're in the same group. It should be disclosed. The reason why is because they are related party. Okay, they are related party. The parent and the subsidiary, they are related party. So if you are giving any loan to it, it should be disclosed. Next, accounting periods should be coterminous. That what does it mean? Or within 3 months of each other. See, your auditing period and your accounting period might be different, right? For example, your accounting period year end might be 31st December, but your auditing year end might be 30th April. So it should fall within 3 months of each other. Okay. That means the difference could be only for 3 months, not more than 3 months. Okay, it should be within that 3 months. It should not be more than 3 months, the accounting and the auditing. Otherwise, if it is more than 3 months, what should you do? Consolidation adjustments are required. Okay, and whatever the subsequent event, you need to consider it. Whether there are any addition or disposal after the reporting year. Then, consider changes in group structure. Your group structure might change. One subsidiary might leave the group, they might buy another subsidiary, so group structure changes, then you need to consider. Then, consider loss-making subsidiaries and the need for impairment to investments and goodwill. Okay, and also if there are any restrictions on distributions of profit, this should be indicated in the financial statements. For example, the government in the subsidiary country, they have put a restriction on the amount of remittance that could be remitted to the parent company back in your country. Let's say you are the parent and your subsidiary is not able to pay back, is not able to send you the remittance from their country because the government has put restrictions on the remittance. Right? You need to indicate this in the financial statements. Because it limits your profit. It is your amount of profit that you are not receiving. So this should be indicated in the financial statements. Next, joint audit. What is joint audit? Joint audit means when the parent company auditors are appointed jointly with the existing auditor of a subsidiary. Okay? Joint, look at the word jointly. Both are auditor. What are the requirements for effective joint audit? Number 1, there should be a meeting between the two firms to decide on timing as well as work allocation. Number 2, final meeting will discuss audit issues, conclusions, management letter, and joint audit opinion. And proper work allocation to avoid dominance so that no one party dominates over each other. Properly you are allocating the work among the two. If the work is properly allocated, meeting has been conducted effectively, that means it's an effective joint audit. If these things are missing, no proper meeting is held, work are not allocated properly, one party is dominating over the other, then it's an ineffective joint audit. Then both firms should have an adequate professional indemnity insurance. Okay. Then we are going to the advantages. What are the advantages of joint audit? Number 1, improve service through firms' different expertise. See, every firm, people have different expertise. If they are combined, services are improved. Second, improved geographical coverage. Subsidiary auditor will be covering another geographical location. Parent company will be serving another geographical coverage. Hence, you will be serving a wider geographical area. Use of two independent firms can provide added assurance to the client because now there are two independent firms, right? So your assurance will increase. Disadvantages. Number one, each joint auditor takes responsibility for the other shortcoming. If one auditor is not performing well, responsibility comes on the other person's shoulder. That's a disadvantage because you're joined, you know. Second, it can be expensive. Different firm audit methods may not be reconciled. It's hard to reconcile if you are using two different methods. The two auditors are using two different audit methods. Not every time you can reconcile the two. Close control of division of work is required. Yes, you have to closely control the division of work. When you're separating the work among the two also, it has to be closely controlled. It is required. So it's a disadvantage. You cannot do it closely if it's an overseas subsidiary. Overseas subsidiary, hence your auditor will be overseas. Special consideration. Now let us look into the special considerations. What are the special considerations? See, subsidiaries in developing countries, they might not have a fully developed system of accounting as well as auditing standards. So what should the group auditor do in this case? Where your subsidiary is not having the access to fully developed system of accounting as well as auditing standard. Then they can request group directors to adjust the financial statements to comply with IFRS standard. Group directors, okay? Auditor is going to request the director. Second, require the local auditor to conform to ISA or to perform further audit procedure. Then, if one or more of the subsidiary has a modified auditor's opinion, what should the group auditor do? It does not matter who the auditor was, okay? It could be any auditor. But if you see more than one auditor in the subsidiary are giving a modified opinion, what should the group auditor do in that case? They could eliminate, they could ignore. If the they can ignore the matter if immaterial at a group level. At the group level, it is immaterial. It does not matter at the subsidiaries level whether it is material or not. At the group's level, if it's immaterial, group auditor ignores it. That modified opinion is ignored. That means they don't take it into the consideration. If the group auditor has to give an unmodified opinion, they will still go by that. But if the matter is material, then group auditor has to modify the opinion. Okay, if it is material at the group level. Next, in accounting terms, we have seen this in the first few slides, that if in accounting term group is a single entity, but in legal terms it is a collection of legal entities. That's why component entity may not be a going concern without the support of the group. You need the support of the group to be a going concern, okay, the component entity, because it is a collection of legal entity. Next, the custom is for the director to give the auditor a support or a comfort letter. Okay, director has to give this support to the auditor, a letter to the auditor assuring that the group will support the subsidiary. Okay, and remember, when they are giving this letter, this is taken as an valid audit evidence for the auditor of the going concern, okay, of the subsidiary. Going concern of the subsidiary. You can assume that the subsidiary will be a going concern, and the letter that you are receiving from the auditor can be used as a valid audit evidence. Okay, because they told that the group will support the subsidiary. Then at this level means at P level, at your AAA, you are not going to get a scenario which is very basic, which is very simple. You are going to get scenarios which will include a complex element such as groups. You will get a question on group auditing. There is no doubt about it. So you have to be prepared for it. As such, it is important to be aware of the main accounting as well as auditing issues involved. Okay, what is transnational audit? Transnational audit is an audit of financial statements which is relied upon outside the auditing entity's home jurisdiction. Wherever you are located, it is outside that country. You are relying on it. Transnational, outside the country, outside your home's jurisdiction. Second, why do you rely on this audit? It could be for the purpose of significant lending. Maybe you are giving significant lending overseas, or investment, you are investing heavily overseas, or regulatory decisions. Then the difference between the normal audit and this transnational audit is due to four reasons, because there are changes, there are variations in this four things. Normal audit means it is following one set of legal and regulatory environment. It is in the boundary of one set of rules in one country. So normal audit versus transnational audit, why it is different? Because there are changes in the auditing standard, variations in auditing standard, number one. Number two, regulation and oversight of auditors are different for transnational and for the normal audit. Then financial reporting standards varies, and corporate governance requirements also varies. Okay, so because of this things, this four, there are variations in these four areas. That's why transnational audits are conducted. So that's it. And these are the exam kit questions for your group accounts that you can do. So now we are moving on to topic number 9, which is evidence. In evidence, we are going to cover obtaining audit evidence, related party transactions, using the work of an auditor's expert, using the work of an internal audit, outsourcing and the auditor, and automated tools and techniques. So first let us start with obtaining audit evidence. All the audit evidence needs to have two features. One, they should be sufficient. The other one, they have to be appropriate. The reason why, because auditors draw their conclusions, reasonable conclusions, based on the evidences that they collect, which has to be both sufficient as well as appropriate. The meaning of sufficient means quantity, right? You should have the necessary quantity. You should not have quantity which is too less. For example, you are only using one type of audit evidence, which is too less, for especially for risky transactions. Okay, so you have to use your judgment. You have to decide what is that necessary quantity is. Then we are coming to appropriate. Appropriate is more about the quality of the evidences that they are using. Okay, and it has to be both reliable as well as relevant. For example, if you are looking the factors for sufficiency, how do you determine sufficiency? You look at number of factors to determine whether the audit evidence is sufficient or not. You look at the materiality of the item. If the materiality is huge, right, you need to collect more evidence. You have to increase the number. Auditor's knowledge, you need to have a knowledge and also judgment to decide that this is sufficient or not, or do you need more. Remember, audit evidence is one of the very critical area for your AAA exam. You will be asked in a scenario. They will give you a scenario and they will ask you what are the types of audit evidence that you might need. Then coming to appropriate. Appropriate is, it has to be relevant as well as it has to be reliable. The meaning of relevant means, okay, evidences is required that will enable the auditors to make a conclusion on the financial statements assertions. For example, whether the financial statements are complete, whether the financial statements are presented in a correct way, right? All those things. Coming to reliable. When you're looking at the evidences, remember, evidence has to be reliable. It has to come from an authorized person. Okay? And some sources of evidences are more reliable than other. For example, written source of evidence, anything that is documented rather than oral. Okay, anything that is external, outside the entity. Third party confirmations we are receiving. This is more reliable than the inquiring the management. And something which is original. For example, photocopy documents are considered less reliable compared to the original. Okay, now let us go to the audit testing techniques. You need to know this audit testing techniques. Okay, but you need to link this with the scenario that is given to you. You cannot use all the audit techniques. Okay, you just cannot give the list of all the audit techniques. It depends on the case study that you're giving. whether you have to recalculate, whether you have to do reperformance, analytical procedure, inquiry of the management, inspect, observation, confirmation from the external party. You need to check. Okay. For example, one example, you want to check whether the receivable amount balance is correct or not. What will you do? You cannot go and observe that, right? Observation will not help you there. You have to go and confirm with the customer. So confirmation is a better auditing technique in this case, not observation. When you're doing ratios and all, for example, you want to calculate see the trend of the sales turnover, whether it's increasing or decreasing. Analytical procedure or recalculation is a better audit technique than inquiry or inspection. So every scenario requires different audit techniques, testing techniques. Okay, you cannot use an audit testing techniques in every organization. You cannot use the same audit technique only. It depends on the scenario to scenario. Some conditions requires inquiry, some conditions require observation, some requires confirmation. So you need to have a very good understanding of this, because these are just general audit techniques. You have to link with the scenario that will be given to you. Now we are moving to the related party transactions, one of the very important area. Because auditors usually check for this, whether there's any related party transaction that has happened or not, whether the two entities are related or not. And if any transaction happens between the related party, it needs to be disclosed. Okay, so ISA 24 says, okay, which talks about related party disclosure. Wherever the control exists, whether the transaction has happened or not, you have to disclose it. Whenever the control exists, for example, the parent are doing any transactions with the subsidiary, parent is having a control over the subsidiary, it needs to be disclosed. Even though the parent is not having any transaction with the subsidiary, but they have a relationship, parent controls the subsidiary. Therefore, there's a related party. They are related party now. You have to disclose it. IAS 24 says that. And IAS 24, this is your not auditing standard, this is your accounting standard, okay? You need to know both your accounting as well as auditing standard. Next, where the transactions have taken place, then what? If the transactions have taken place, then you have to make disclosure of these things. Number one, nature of relationship. Who is a related party to you? Is he a family member? Is he a subsidiary? Is he a joint venture? Who is he? Then, types of transactions. What are the types of transactions that is taking place? Elements of the transactions necessary for an understanding of the financial statements. What is that element of the transaction? Is it affecting the sales? Is it affecting the purchases? Are you taking a loan? What is the element? Parties are related if one has the ability to control or exercise significant influence. That means he can be a subsidiary or an associate. Both will be taken as a related party. Now, there are some audit risk related to this related party transaction. That's the whole point we are studying this here. If there was no audit risk, there is no point of learning this separately. Of course, there are so many transaction that affects audit risk, but some areas are more material. One example is related party transaction. That's why it's highlighted separately. So what are the audit risks? Number one, directors may be reluctant to disclose such transactions, especially when the transactions are done with the family members, right? Number two, transactions may not be easy to identify from the accounting systems. Auditors cannot tell whether they are related or not. Third, transactions may be concealed in whole or partially it might be concealed for fraudulent purposes. If any fraud is happening, okay, if they are involved in any fraud, both the related parties, they can easily conceal it. So it will be very hard for the auditors to trace. That's why this is a very risky area for the auditors. Okay. Then we are moving on to some procedures that they need to do to minimize the risk of this related party transactions. So these are the audit procedures to identify whether they are related parties or not. Number one, you can review the accounting records. For example, are there any large unusual balances or unusual transactions that's happening place which is not in the normal course of business? Suddenly you see the sale increased from one account only. So you need to verify, you need to review this. If there's an unusual balance and all, it's an indication that there might be related party. Second, review of board meetings. Third, confirm with the bank. Review the bank confirmation and also the loans receivable and payable. Because usually the related party transactions are relating to loans and all. One party is giving loan to another party, which they might conceal. So you can go and review with the bank confirmation. Inquiry of the management. Ask the management, are they any related party or not? Review of invoices and lawyers' correspondence. Invoices, because sales and all, sales, purchases, intra-group sales and purchases, they can manipulate. So you review the invoice and also lawyers' correspondence. Now we are moving on to the use of working of an auditor's expert. In auditing, you rely on the work of someone else. It is permitted, but certain conditions needs to be met. You cannot entirely 100% depend on it. There are some scope for it, but you can rely. One is auditor's expert, the other one is internal audit. First, let us go through the auditor's expert. That means you are taking the help of an expert. Auditor is taking the help of an expert. Okay? Because auditors might not be having the knowledge of all the areas in the audit. Some areas they might need some expert. So, use of the auditor's expert, okay? It says, ISA 620 says, auditors cannot delegate responsibility to expert. It is auditor's responsibility to carry out the audit. Even though they are taking the help of the expert, they cannot delegate that responsibility to the expert. That's a restriction. Second, these are the examples of experts such as surveyor, valuer, expert inventory counters or actuaries. Then we are moving on to auditor, right? Auditor is still responsible for obtaining sufficient and appropriate audit evidence. You cannot say that I'm relying on the expert, that's why if I don't get the sufficient and appropriate audit evidence, it's okay. No. Relying on the expert is not known as sufficient and appropriate audit evidence. You cannot use it as an audit evidence. Okay? Experts, when you're using the expert, they must be independent, they must be objective, they must be competent and experienced. Definitely, they has to be experienced more than the auditor. Okay? They have to be expert in that field. Then we are moving on to the audit report. Unmodified audit reports do not refer to the use of expert. When you're using the expert, an auditor has issued an unmodified report, you cannot write in that report that you are making the use of expert. That's why you're giving an unmodified audit report. No. Before the work is done by the expert, auditors need to check certain things in the expert. Before they have done the work, what is it? Number one, you have to agree the nature, scope, and objective. Among themselves, they have to agree on this. Agree the roles and responsibilities. What is the role of the auditor? What will be the role of the expert? Nature, timing, and extent of communication. How they are going to communicate. How frequently are they going to communicate? What is the medium of their communication? Agree the need for the expert to observe a confidentiality. Whatever is transferred or shared among the two needs to be kept confidential. You cannot share it with third party. Neither the expert, neither the auditor. Then, evaluating the work of an expert. After you have done, right? Before the the expert has done their work, you have evaluated, you have agreed on certain things. Now, after they have done their work, you need to evaluate. You just cannot accept whatever the work they have done. You need to evaluate further the work of an expert. You need to see whether they are reasonable and relevant, the findings that they got. Okay. Number two, assumptions. You need to question their assumption. Is it relevant? It is reasonable? You have to see the relevance, the completeness, and the accuracy of the source data. From which source are they taking this? Is it relevant? Is it complete? Is it accurate? Now we are moving to the use of work of internal audit. The same procedure that we have done for the expert, we have to do for the internal audit as well. But there will be some changes. Okay? When it is internal audit, because internal audit is an employee of the company. So, here also when you're using the work, there are some limitations, some scope. What is it? External auditor may wish to rely. If you want, you can rely. It's not compulsory that you have to rely on the work of internal audit. If external auditors wish, they can rely on the work of internal audit. The reason is because this will help the external auditor later on to minimize their work. They might not have to do detailed testing now, because whatever they wanted to test have already been done by the internal audit. Okay. Now, here also you have to assess the internal audit function. That means before you rely on the internal auditor's work, you need to see certain things. Number one, organizational status. What is the organizational status? Scope of the function. What is the scope of the internal function? For example, the area that you wanted to test, the external auditor wants to test, might not have been done by the internal audit because they had a limitation of the scope. So you have to check first. Technical competence. Are the internal auditors technical and competent? Due professional care. Are they following the ethical principle? Due professional care. They are performing with professional care. Then after these things, you are assessing, you are evaluating the work of the internal audit. That means internal audit has done their work. Now you are evaluating. Okay. Sufficient appropriate evidence obtained. Whether it helps you to obtain sufficient appropriate evidence. Next, conclusions are valid. Is it valid or not? You have to check. Work has been properly supervised and reviewed. Remember, internal auditor's work has to be reviewed and supervised by the external auditor. Using internal audit to provide direct assistance. You can use internal audit's work to directly assist you. That means it's helping you directly. Means he's also doing some of the auditing work of you, which is the role of the external auditor. But there are some conditions. You cannot always do that, right? So let's go. IA, internal audit function can provide direct assistance to external auditor under their supervision and review. When you are using direct assistance of the internal auditor, remember, external auditor has to supervise himself and he only has to review it so that independence is maintained. Second, if the law and regulation prohibit such assistance, you cannot take their assistance. Sometimes law might prohibit that you cannot use the internal auditor for your direct assistance. You cannot use it. Third, competence and the objectivity of the internal auditor must be considered. They have to be independent and they have to have the competency. Areas wherever there significant judgment are involved, right? Or there's a high risk of material misstatement. Internal auditor cannot be used in such area. External auditor only has to do the work by himself. Then, planned work must be communicated with, charged with governance. For example, non-executive director, audit committee cannot make excessive use of internal auditor. You cannot excessively use. For example, for your audit work, 90% of the work you are using the help of internal auditor. It cannot be. That is called as excessively. No. You can only use him for partially for some amount of time, right? Not excessively. Maybe 10%, 5% of their work you're using. Management must not intervene in that work. Management cannot come and say anything because internal audit is the employee in the company, right? So management cannot come and intervene in that when they are providing direct assistance to the external auditor. Internal auditor must keep the external auditor's information confidential. He cannot disclose it to the company. External auditor has to provide direction, supervision, and review on the internal auditor's work. And external auditor should remain alert to the risk. There's a risk that internal auditor might not be objective or competent. So external auditor, whenever taking the help of internal audit, they have to keep this in mind. They might not have the competency or they might not be objective. Now let us move on to the outsourcing and the auditor. Sometimes you might outsource some services to outsider. Okay, so there, what is the implications for the external auditor? So ISA 402 says, okay, this is relating to entity who is using a service organization. Okay, how will this impact the auditor? Auditor then has to obtain an understanding of that service organization also. Okay, earlier it was just the entity that auditor has to understand. Now the service organization also auditor has to understand. What are the things that he needs to understand? What is the nature of the services that is provided? What is the relationship with the client? What is the materiality of the transaction? All these things auditor needs to have an understanding of. And how can auditors have that understanding? Through inquiries with client. You can ask the client directly. Confirmation from the service organization's auditor. Okay, you can confirm with the auditor of the service organization. Visit to the service organization. You can have a visit. Type 1 or type 2 report from service organization auditor. Okay, what is type 2 report? Type 2 report is when your internal control is working effectively, and whatever the report produced from that is known as type 2 report. Okay, so you need to decide and you need to perform audit procedures which is responsive to those risks. If controls are expected to operate effectively, that means controls are working effectively, then type 2 report is available. Okay, then perform the test of control at the service organization, not your client, service organization client. Use another auditor to perform the test of control. Okay, when you're performing that test of control at the service organization, make sure that you're using another auditor. Reporting. So when it comes to reporting, what is the implication for reporting? Here also you have to consider whether sufficient and appropriate audit evidence has been obtained or not. If not, modify the opinion. Then, auditor is fully responsible for their opinion. This is what you need to know. Even if you're making use of the service organization and relying on the auditor, you cannot make them responsible for it. You are responsible for your opinion. Okay, and even in the report, you cannot mention that you are using the service organization or their auditor. Automated tools and techniques. So when it comes to automated tools and techniques, we know that there is now thousands of software for auditing and all. Right? Now, two things you need to know, two terms. One is test data, the other one is audit software. What is test data? Test data means auditors are testing data. Right? These are not the actual data. These are some data. It's like a sample that auditor have generated, and then now they are putting this in the client's computer system to make sure whether the system is working or not. They want to check, test. Okay, it's not the final data. It's a raw data. And audit software, this is specially designed for the audit purposes. Okay, some software is there. For your exams point of view, you don't have to know the detail of the software, how software is designed, what are the software and all. No. Just have an understanding that there are software designed for audit. Okay. Then test data means you are using dummy data. Okay, to make sure whether the system or the control is working or not. Because before you actually start putting the actual data and start working with the system, you first need to use some raw data and check whether it's working or not. Okay, if it's working, then you start working on it. Otherwise, you have to modify the system. Valid data should be accepted and invalid data should be rejected. So if your system accepts invalid data, you cannot use that data. You still have to keep updating the system, modify the system until it accepts only valid data and rejects invalid data. Okay, now coming to the audit software. Audit software, it is used for mainly four things. First, selecting sample. It can help you to select samples very easily. Number two, computations. When you have to check any arithmetical accuracy or not, or re-perform any calculations, software can easily do it, right? Comparing two. So for comparison purpose also, this is much faster. And wherever you have to perform detailed analytical review means you have to calculate ratios to see the trend and all, it can be easily be done by the software, and software can create report also easily on that. Yeah, right. Now, data analytics. This is a new term. What is data analytics? You must be aware of this. This is a very new term and you should know it. Data analytics is a science of examining large data set, that is also known as big data, in your performance management. You must have heard what is big data. when there is a large data set. For example, one example is Facebook. How many data are we are dealing in the Facebook? Per day, how many pictures, videos, status are being uploaded? So it's a big data. If you are taking the data out, extracting the data, the raw data is meaningless, right? You have to first rearrange the data. You have to clean the data to draw useful conclusions from that data. And it's a large set of data, okay, very, very large set. That is known as big data. The volume is huge, varieties are so many, okay. So here also in auditing also, you have to deal with big data. And data analytics are more sophisticated form of computer assisted audit technique. These are very sophisticated. We have a separate professionals for dealing with this data analytics and all. They analyze the data. Their job is to sit behind the screen and analyze the data. And it's a very heavily paid job, right? But you need to have lots of experience and you need to have the patience of dealing with huge numbers and all behind the screen. Because data scientists, data analytics are paid very heavily, hugely. Because these are very sophisticated area, complex area, okay? And for that, you need audit software, you need the computer. You manually cannot do data analytics and all. Benefits of automated tools and techniques. What are the benefits? Number one, it allows to manipulate 100% of the data in a population very quickly. You can change the data. One variable you can see and see the impact very easily. Next, throughout the data, it can be used to help identify risk. Number one, test the control, and as a part of substantive procedure also you can use this. Wherever detailed procedures are required, you can use this because this will be done faster and in an easier way. Audit quality will increase because sampling risk is reduced, so audit quality will increase. Audit quality increases means auditor's liability risk is reduced. Then audit procedures can be performed quickly and at a higher standard. They can be carried out, audit procedures can be carried out on a continuous basis. It's not just once. Continuous basis it can carry out rather than focusing it at the year end only. Anytime you want to do the audit procedure, you can carry out. Reporting to the client and users will be more timely, yes, because you can carry out at any time, continuous basis. So anytime you can create a report and send it to the client. And it can be customized also from user to user. From exams point of view, okay, these are the areas that you need to know, have an understanding of this. One is audit evidence. This syllabus area is critical to the exam, very important. A common exam question from the past paper is this, okay, state the audit evidence you would expect to find. This is one of the common questions. Good thing about AAA is very limited. The type of questions are very limited to few questions. They cannot ask you a wide variety of questions. So that's a good thing for AAA. Even though AAA is hard to pass rate and all is low, the good thing is questions are repeated. If you see the past paper, if you see the trend, often the questions are repeated. Questions are very much similar. They cannot ask you new different questions, okay? It's very rare. You will not find out. Unlike other papers, like AFM or SBL, questions varies, but not in AAA. So that's a good thing that AAA students can use for their benefit because then they know the pattern and then they can accordingly study and answer like that. Next, you will be expected to be aware of the merit of different types of evidences. You should know what are the advantages of observation, what are the advantages of inquiry, what are the observations of recalculation. You should know, and how far they are reliable. Because in the exam, you will also be expected to consider the alternative sources. You may have to compare the two types of sources. Then the key points that are covered in ISA, International Standard of Auditing. In this section, whatever the key points I have covered, whether it is related to outsourcing, whether it is related to related party, whether it is related to the automated tools and techniques, will be helpful for you to answer your questions. Okay, it will help you to answer such questions relating to audit evidence. So basically you need to apply your knowledge in the scenario. You have to link all these techniques with the scenario. Now, what are the questions that you need to do from the revision kit? These are the questions that you can do. Ryder Group, Mark Road, Audrey, Radbig, Eagle, and the following. Now let us go to the topic number 10. Topic number 10 is completion. So here we are going to cover subsequent event. Completion means we have completed the audit event. Now we are towards the end, that stage. So at this stage, we look for subsequent event, the events after the reporting date. Going concern, overall review, evaluation of the misstatement, written representations. So let us start with the subsequent event. Subsequent event, okay. There are 3 timeline for subsequent event. 1, up to the date of auditor's report. What are the things we have to disclose? So auditor should perform procedure to design to obtain sufficient and appropriate audit evidence up to the date of the auditor's report. Okay, so if there is any event that came up before the auditor's report date, you have to disclose it. You might have to require some adjustments you might have to do, or if adjustment is not required, if it's not an adjusting situation, then you have to disclose it. If you identify anything before the auditor's report date. Second, after the date of the auditor's report but before the financial statements are issued. This is the second timeline. Here, auditor has no responsibility to perform further procedures, to make any inquiry regarding the financial statements after the auditor's report date. Okay, if any changes happens after the auditor's report date, auditor is not responsible to perform procedures. Okay, but if auditors become aware of this change, okay, then they should discuss this with the management. And also they might have to consider the implications of the auditor's report, because they might have to modify the auditor's report also, if it comes in the attention of the auditor. Okay. Third, after the financial statements are issued, then no obligation. Auditor has no obligation to make any inquiry. If new information comes, okay, then what? But if new information comes that is relating prior to the date of auditor's report, that means information came before the auditor's report, then auditor should consider this into the picture. Then they might have to revise their financial statements and also discuss this with the management. Going concern. Going concern is also a very important topic, even from an exam's point of view also, because usually this is given, one question is given where going concern, there's an issue with the going concern. Okay, so what should you do? Number 1, the first box, okay. Management is required to make an assessment of the enterprise ability to, who makes that assessment, whether the entity is going concern or not? It is the management, not the auditor. Auditor is reviewing that, whether it is correct or not, that assumption. But it is a management who is doing that assessment of going concern or not. And it needs to look at the following factor. Okay, it's considering the following factor. One is financial. For example, you are looking the balance sheet position, right? You are looking the position of the financial statements. Is it good or not? If it's bad, then it's an indication that you might be having some problem with going concern. Budgeted negative cash flow. If you're having a budgeted negative cash flow, that is also another issue. Third, maturing debts without realistic prospect of repayment. That means you are not able to repay them back. Okay. Operating example. Operating example means loss of key management without replacement. Loss of major market. So these are some examples of issues that might lead to going concern problem, right? Other example, non-compliance with capital or other statutory requirements. You are not complying with the requirements, the law. The second box here, auditor needs to review. This is the role of the auditor. The first box we were talking about the management. They need to review. Sorry, they need to assess. Now the auditors are reviewing that management's going concern assessment. Okay. First management will assess. After they have assessed, they will say, that looking at this factor, I feel entity will be a going concern, or I feel it will not be going concern. Auditor will come and review that. Okay, they need to gather sufficient and appropriate evidence to confirm whether it's a going concern or not. Okay, but in carrying out the evaluation, these are the procedures that should be included. Number one, analyzing and discussing latest and the budgeted financial information. Auditor has to discuss what is the latest budget. Second, read the board meetings. Remember, these are audit procedures, okay? So auditors has to read the board meetings, because in the board meetings they will come to know if there is any financial difficulty or any future plan. Third, loan agreement. You need to review the loan agreement. Why loan agreement? Because loan is very important when it comes to going. A lot of the company that has gone bankrupt is because of the loans, heavy loans that they have taken, and they are unable to pay the debt holders. That's the reason you have to review the loan agreement terms to see whether the company is breaching or not on their debt, breaching the debt covenant or not. Okay. Now let us go to the overall review. You need to do an overall review after going concerns. Overall review, it includes this 6 things. You need to ask, do the financial statements comply with the statute as well as the accounting standard? Does it comply with the law as well as the accounting standard? For example, does it comply with the IFRS or IAS standard or the auditing standard? Second, are the financial statements consistent with our knowledge of business? Our knowledge means the auditor's knowledge of business. Is it consistent? It should match with each other. Okay, the financial statements, whatever the figures given, should match with your understanding of the business. Third, is the quality of the audit work up to standard? Is it up to standard? Then, have appropriate accounting policies being followed? Do the financial statements give the true and a fair view? Have the firm's procedure being followed? So these are the 6 questions you need to ask when you are doing the overall review. Now we are moving on to the overall review. The reviewer should ask these following questions. Has the work been performed in accordance with professional standard? So these are the exact same things that we went through the diagram, if you see. Okay, it's just a repetition. What significant matters have been raised for further consideration? Has the appropriate consultations taken place? Okay, and are the resulting conclusions, are they documented and implemented? Remember, everything, whatever you do, overall review, the planning stage, everything needs to be documented. Okay, is there any need to revise the nature, the timing, and the extent of the work performed? Do you have to increase your work? Do you have to change the timing? You have to see this. In the overall review, you will come to know this. Does the work performed support the conclusions reached? If it's not, then you have to do more work, or you might have to change the type of the work that you are doing. Is the work appropriately documented? Everything needs to be documented. Is the evidence obtained sufficient and appropriate to support the auditor's report? Have the objectives of the engagement procedure have been achieved? What is the objective of the engagement procedure? Why are you engaging there? To say that the financial statements are true and fair. It is giving a true and a fair view, and it complies with all the IFRS standard. Right? So is it met? Evaluation of the misstatement. After the overall review comes the evaluation of the misstatement. If there is any misstatement, you need to evaluate this. All identified errors should be recorded on a working paper set up for the purpose. Okay, whenever you have an error, you just cannot ignore it, or you just cannot keep it without recording it. You have to record it on the working paper. You have to write it somewhere. Individually immaterial errors may in aggregate amount to a material difference. Sometimes an error looks immaterial, but it is individually immaterial. When you aggregate it with other errors, in total it becomes material. You need to consider that as well. Aggregate the immaterial totals and see whether it is becoming a material difference or not. Management should be requested to adjust all identified misstatements. Who adjusts the identified misstatement? Management, not the auditor. And all uncorrected misstatements should be communicated with those charged with governance. The ones which are not corrected. And also the description of the implications for the auditor's report. What could be the implication of this uncorrected misstatement in the auditor's report? Will it lead to an modified audit opinion? You have to check that. If appropriate, okay? If any material misstatement remain unadjusted, you are not correcting the material misstatement, auditor have to modify the audit opinion. You cannot issue an unmodified opinion in that case. Written representation. Written representation is also a source of evidence only. You are taking the written representation from the management, which is not considered so reliable, but at times you have to use it. What are the key revision points? Where management make oral representations, means orally they are telling to you through mouth. Okay. Why? To avoid misunderstanding. So you might need this oral representation to avoid any misunderstanding, and this is considered more reliable audit evidence. Why? Because auditors will not have a chance of misunderstanding the situation or misunderstanding what has been said, because orally they are saying, so they can see the expression of the client, they can see everything, right? Visually. But this representations are documented later. You have to document even though it's verbally said. You cannot say in your auditor's report, okay, they have verbally told. No, you have to document it that this is said on this date. The management representations may be the primary source of evidence, but they are not a substitute for other evidences that may be available. Remember, the primary source of evidence, the first source of evidences that you look for is the written representation from the management. That they are not involved in any fraud, they are complying with the standards, they are internal, the control is working effectively. All this you are taking written representation from the management, but you cannot use this as a substitute. You cannot say because I have taken a written representation, I don't have to use other evidences to check whether it is correct or not. You have to. Still you have to use other evidences. Okay, but this is the primary source of evidence, first source of evidences. Then you go for the other types of the secondary sources of evidences. For example, you confirm with the customer, you go and review the bank loan agreements and all those things to see whether the management representation is correct or not. If contradictory evidence is found, further investigation is required. If you see the evidences that you have collected from other sources versus the management representation, if they are not consistent, you have to do further investigation. Management should be informed of the existence of the letter. Okay, they have to know that there is a letter like this, so that there is no misunderstanding and no conflict. Conflicts can be avoided later on. But what if the management refuses to cooperate with the auditor? What if they don't want to give the written representation? Then what? Then auditor should modify the audit opinion. Why? Due to lack of sufficiently reliable evidence, because you are not getting sufficiently reliable evidence, therefore you modify the audit opinion based on that. That is the basis. Remember, all the audit evidences that you are learning, the one thing you need to know is how it affects your audit opinion. That's the main thing that you have to know. Next, matters that are included in a written representation letter. What are the things that are included? You need to know this. 1. General matters. General matters like the responsibility of the management. Okay. Management has fulfilled its responsibility for preparing the financial statement. Management has to say that it is their responsibility to prepare financial statements, and they have fulfilled that responsibility. In the general matter section, they are writing this. Second, management has provided the auditor all the relevant information relating to the audit. That also they are writing it and giving. Next are matters that are required by other standard. For example, all known and suspected frauds have been communicated to the auditor. You have to write this in a written representation letter, because ISA 240 says that that if there is any fraud that is known or suspected by the management, it has been communicated to the auditor. Management has already told that to the auditor. Second, if they don't comply with the laws and regulation, that is also communicated to the auditor. All the situations where they have not complied, it is told to the auditor. Then, management believe the effect of uncorrected misstatements are immaterial. For example, you told that you are not correcting the misstatement because you believe it's immaterial. That also you have to give to the auditor in writing. All related parties and related party disclosures have been disclosed. This also you have to give a written representation. Subsequent event has been communicated to the auditor. Going concern issue has been communicated to the auditor. So if you see how many issues are there now, one is fraud, the other one is non-compliance, other one is immaterial misstatement, related party, subsequent event, going concern issue. All these things you need to have a written representation letter from the management in all these areas. And specific matter. A specific matter, matters involving management judgment or intentions of the management. Okay, matters which involve the management judgment, you have to write it, that you have used this judgment or this was the intention of the management. You have to give it in writing to the auditor, because how will the auditor know that this is your judgment, this is your intention? They will not know if you don't write it and give it to them, right? But for specific matter, because judgments, management judgments are not required in all the areas, some areas require that, so in those areas only you have to write it in a letter and give it to the auditor. So exam focus, you need to focus on this questions from your exam kit. Now the next topic we'll be covering reporting. In reporting, we are going to cover Auditor's Report, reporting to those charged with governance, communicating deficiencies in internal control. So these are the three things that we are going to cover. Let us start with the Auditor's Report. These are some of the differences between the UK syllabus and the international syllabus relating to the Auditor's Report. Okay, this is the content, this is the format of the Auditor's Report. It starts with the title, we have addressee, the auditor's opinion, basis for opinion, materiality, uncertainty relating to going concern, emphasis of matter, key audit matters, other information, responsibility of the management, auditor's responsibility, report on legal and regulatory requirements, other matters, signature, date, auditor's address. Most of the things are similar to the UK syllabus, but we are following the international syllabus. But it's good to know the UK syllabus as well. In case you want to go to UK and work over there, you should know the differences with the international syllabus. But the AAA that we are following, we are going to do is the international syllabus that I'm covering. Okay, so you need to focus on the international syllabus. But for the work purpose and all, if you want to work in UK and all, it's better to have the differences with the UK syllabus as well. Okay, but in your exam you will only be asked for the international syllabus if you are giving the international syllabus exam. Almost everything is similar. The only differences that comes is one is materiality. Okay, they might write it as conclusion relating to going concern, and the other area is key audit matter. Okay, there they are going to write in UK, they are going to add our application of materiality and also the overview of scope of our audit relating to listed company, right? But for international syllabus, it is only known as key audit matters for listed companies. And then we have some extra things in UK syllabus which is not there in international syllabus, such as matters on which we are required to report by exception, that is not in the international syllabus. Then opinion on other matters prescribed by Companies Act 2006, that is not in the international syllabus. Okay, responsibilities of directors. Okay, it is known as responsibility of directors in UK syllabus, but for international syllabus it is known as responsibilities of management. So other than this few, one or two areas, rest all remains the same. Now let us go to the audit opinion. There are two types of opinion that an auditor can give. One is known as unmodified opinion. What is the meaning of unmodified opinion? Unmodified opinion is like a clean opinion. That means your financial statements is following all the standards, right? All the financial reporting standards. It is giving a true and a fair view. There is no material misstatement in that financial statements. So if this is the case, then auditors issue an unmodified opinion in their report. Modified opinion. What are modified opinion? You have to make modifications to the opinion if certain conditions are there. One, if the financial statements are not free from material misstatement. Number two, you are not able to get the sufficient appropriate evidence. Sometimes it happens that you are unable to get the sufficient appropriate evidences. So in this two cases, you need to modify the audit opinion. You cannot issue an unmodified opinion. Okay. Now, the wording of the opinion that depends upon whether the misstatement is, when you're writing the word that this is the opinion, qualified opinion or adverse opinion, you need to write it when you're writing it depends on the misstatement, the type of misstatement it is. For example, material but not pervasive. What does it mean? It means misstatement is there, but it is isolated to certain elements. Only certain elements are misstated in the financial statements, not the overall financial statements. Or the other one is material and pervasive. That means as a whole, your financial statement is not reliable. Okay, that misstatement is having the effect on every other item in the financial statement. So overall, your financial statement is material misstated. So you need to see the word material but not pervasive, material and pervasive. I've highlighted it in bold because these are the exact wordings that you need to write in the auditor's report when you're basing your opinion based on what. Now, let us go to a table, okay, through which you will know how to give a correct opinion. Okay, you might be sometimes worrying, how do I know the correct opinion? Especially when it's the modified audit opinion. Unmodified is okay. No material misstatement. You are getting the sufficient appropriate evidence. Hence, it's unmodified. But modified audit opinion, you need to look at these four things. Number one, whether it is material and not pervasive, material and pervasive. The opinion changes. And financial statements that contain material misstatement versus unable to obtain sufficient appropriate evidence. So if it is material but not pervasive, that means it is in isolation, right? Misstatement is in isolation. Only some elements are misstated. And financial statements contain that misstatement. Then your audit opinion will be qualified opinion. Except for means you need to write out that this are the misstatements. Except for this misstatements, it is a qualified opinion. If it is material and pervasive, okay, we didn't go to the evidence part, we are still in the financial statement where it contains misstatement, then it will be adverse opinion. Remember, when it is material and pervasive, the word pervasive means adverse opinion. Okay, it's not a qualified opinion anymore. That means they do not show true and fair view. You have to write it that this financial statement do not show true and a fair view. If it was a qualified opinion, you are going to write except for. That means you will be listing out some misstatements you will be listing out. Except for this statements, financial statement is true and fair. Next, it is depending on the evidences. If you are unable to get the evidence, sufficient and appropriate evidence, and the material is isolated, that means it is overall financial statement is not misstated, only some elements, then your audit opinion will be qualified opinion again, except for. So if you see in both the condition, whether you get the evidence or not, or whether the financial statements are misstated, if it is material, only material, then the opinion is qualified opinion only. If it is material and pervasive, then opinion changes. Okay, if you are unable to obtain sufficient appropriate evidence and also it is material and pervasive, disclaimer of opinion. That means we do not express an opinion. Auditor is not even giving an opinion because he is unable to obtain sufficient and appropriate evidence, as well as it is material and pervasive. make sure that you know this table very well. Okay, because you need to give audit evidence, audit opinion. Sometimes you might be asked to say whether the audit opinion given to you is correct or not. So you should look at the facts like this, whether it is material, whether it is material and purposive, whether you are able to collect evidences and all. Next, we are moving on to the other audit reporting implications. Okay, what would be the impact, whether it will be unmodified or modified, and where in the report this will be written. Okay, so I will be giving you 6 situations and we'll see the impact. Number 1, going concern uncertainties, but it is adequately disclosed. Where is it referred to in the audit report? Under material uncertainty relating to going concern, under this section. Because it's a going concern issue, right? Does it have an impact on the audit report? No. Unmodified, because you have disclosed it. If you didn't disclose it, then it would be a modified opinion. But here you have disclosed it. That's why it's unmodified. Okay, the opinion will be unmodified. Number 2, inconsistencies between other information and the financial information. Where are you going to write this in the audit report? Under the section other information. Okay, see, you can closely link going concern means relating to going concern in the report. Other information means other information. Okay, impact on the opinion unmodified, because when you are having inconsistencies between the other information and the financial statements, it will not lead your opinion to change, because they didn't say whether it is material, misstated, or anything like that. It is different, so it's unmodified. 3, matters of fundamental importance disclosed in the financial statements to be brought by the attention to the user. Emphasis of matter paragraph. Okay, under this paragraph, whatever you want to bring into the attention for the users, you write it here. Emphasis of matter paragraph. And this is also not going to have an impact on the opinion, unmodified, because you have already disclosed it. Then, matters relating to the auditor's responsibility. It will be under other matter paragraph. Okay, because this is relating to matter relating to auditor's responsibility, the audit or the auditor's report to be explained further to the user. So it's not just the auditor's responsibility. If you see there's a comma, it has more things to do. So it's under other matter paragraph. If it was just auditor's responsibility, you can write it under auditor's responsibility, but this includes other things also. So it's other matter paragraph, unmodified. Okay, because it has nothing to do with material misstatement, or it has nothing to do with the not getting sufficient and appropriate evidences. Therefore, it cannot modify your opinion. Number 5, explanation of why a modified opinion is being given. That means the opinion itself is modified. Okay, so if you see, where will it be written in the report? Basis for opinion. What is the basis you are choosing for the opinion that you have given? Okay, and it's modified, because already they have told in the question, explanation why modified opinion, so it's modified. Now, reporting to those charged with governance. You need to report, okay, to those charged with governance. For example, it could be the non-executive director, it could be the audit committee, it could be other managers who are there who are in charge of the governance and all. So you need to report such matters. You need to communicate with them. Number 1, what are the things you need to communicate? A request that all identified misstatements be amended. That means they have to change all the matters. Okay, whatever the misstatement, they need to correct it now. A request to do that. You are requesting the people who are charged with governance to amend the misstatement. Next, wording of expected modifications. Key audit matters. Anything key audit matter, you need to report to them. Okay, these are the areas on which you need to report to those charged with governance. Okay, key audit matters. Auditors responsible in relation to the audit. What is the auditor's responsibility? This also you have to report to them. Plan, scope, and timing of the audit. Definitely. What is the scope of your audit and what is the timing of your audit? Views regarding significant accounting policies and practices. Significant difficulties encountered during the audit. This also you need to report to them. Request for written representation. You sometimes have to take written representation from those as well, other than the manager. Matters that are relevant to the auditor's independence. Okay, because if auditor's independence has been threatened, it can affect your governance. Corporate governance will. That means corporate governance is weak. Okay. So that's the reason we need to communicate this with those who are charged with governance. So these are some matters that you need to report to them. Now, communicating deficiencies in internal control. If your internal control, there is some deficiency that you have to communicate as well. So when you are deciding that you have to communicate about internal control deficiencies, okay, first the auditor should do is they have to see individually as well as aggregate and see whether it is significant or not, whether the deficiency is significant or not, okay, before reporting. Then if necessary, if the auditors feel that it's necessary to communicate, then they need to communicate the deficiencies in the internal control to management. The way you communicate misstatement, any material misstatement to the management, same way deficiencies in internal control also has to be communicated to the management. It needs to be reported. Then any significant deficiencies, okay, this should also be communicated to those charged with governance as well in writing. Okay, you're communicating to the management. Number two, you're communicating with those charged with governance. Those charged with governance and management are not the same person, first of all. Okay, what the communication should include are a description of the deficiency, explanation of their potential effect, what could be the effect of that deficiency, and what is the sufficient information, okay, to understand the context of the communication in relation to the audit process. You need to communicate what are the information that you need in relation to the audit process regarding the internal control. Commonly, additional reports might be required. For example, ISA 260 and 265. Okay, these are referred to as management letters or findings from the audit letters related to internal control. If there are deficiencies in this, then you need this additional report. From exams focus, remember the form and the content of the auditor's report is a very critical area. This question has been asked very frequently. If you see the past paper, go today and check the trend. You will be able to understand that form and the content of the auditor's report is almost asked multiple times. Very frequently it has been asked. Right? It should be asked because it is the last stage, the final stage. Second, be prepared to consider if an item is material, how it affects the interpretation of reader. If an item is material, it can change the interpretation of the user, the one who is reading that financial statement, the one who is reading that report. This also you need to take into consideration. Therefore, whether modification to the auditor's report is required or not, this is also a key area for your exam relating to the modification of the auditor's report. Then, you may have to critically appraise a draft report. Yes, they might give you some draft report, auditor's report. You might have to correct mistakes. Okay. What you should do, you should know the order of the paragraph. Is it in the correct order? If it's not, then you have to correct it. What is the style of the wording used? Is it the correct wording that is used? You have to memorize the style of the wording also. Because every auditor's report is same. The wordings are used same. As well as whether the opinion that they have suggested is appropriate or not, you have to see. Most of the time, the opinion they give is not correct. Most of the time, you have to correct it. That's why make sure that you know the form and the content, the layout of the auditor's report. What comes first, what comes at the end, what is in the middle, what is included in which part, what is the wording, how do they start, all those things. Then, from your exam kit questions, you can do this. So I think there are some 16, 17 questions are there. If not all, then at least few 2 or 3 questions you can go through. Because I don't think that much time is also left that you can go through all the questions now if you haven't gone through before. But if you have gone through before, you can revise it now. So did you take the screenshot or a picture of it? Okay. Now let us go to the next topic. The last topic for day 2, which is audit related services. It's very short. Okay, so in here we are only going to discuss audit related services. Other than audit, what are the services? Okay. These are audit related. Not exactly audit, but apart from audit. For audit related services, okay, there are two types of services. One is known as assurance engagement, the other one is known as agreed upon procedure. What are some examples of assurance engagements? One, engagements to review financial statement. Okay, especially for small companies, because small companies, they are not required by law to audit. So for them, you can review the financial statements if not audit. Then interim financial information, that would be, I will be covering that in day 3. Okay, about interim financial reporting. So that also you can do. Due diligence assignment. Then we have PFI engagements. Then we have environmental social reporting. All this due diligence assignments, PFI engagements, environmental social reporting, I'm going to cover in day 3. Okay, in detail. Agreed upon procedure, even forensic audit. So forensic audit is a type of agreed upon procedure. You do not provide an assurance on this, but you just follow some procedure. Okay, such as fraud investigation, you investigate the fraud, verifying insurance claim, then due diligence. Okay, forensic audit we are going to cover in day 3 in detail. Then, oops, I missed. Okay, so audit related services. Okay, audit related services. On your left there is audit, and the other one on the right, they are related services, two related services. So the difference comes in the nature of service, assurance provided and reports provided in audit versus related services. So what is the nature of service of audit? It is audit only. Okay, for related services we have two. One is review, the other one is agreed upon procedure. Assurance provided for audit is reasonable assurance, but not 100% assurance. But when it comes to a review, it is limited assurance. Make sure that you know the difference between these two. Otherwise, sometimes what happens is for related services, you go and start putting reasonable assurance. Okay, and for agreed upon procedure, there is no assurance at all. You just follow some procedure to get the result. Report provided by audit is the positive assurance on assertions. What does it mean? For example, you write report, the auditor's report, just go and check your auditor's report, right? The financial statements, this financial statement has been complied with all the standard. It gives a true and a fair view. Okay, but when it comes to review, it gives a negative assurance on assertion. Negative assurance on assertion means the wordings will be nothing has come to our attention that concludes that financial statements are not complying with the standard. Okay, the wording is like that. I don't know, I forgot the exact wordings, but it is something like this. Make sure that you go and read the difference in the wordings between these two types of report. And for agreed upon procedure, it is factual findings of procedure. You are just finding out. You're doing procedure, you're finding out, that's it. For example, fraud investigation. You are finding out whether fraud has happened or not. So for that, you need to do some procedure. Okay. Then these are some types of report. For example, for review, we have ISRE 2004. And for factual findings, we have ISRS 4400. Now let us go to the level of assurance. Level of assurance matters a lot, okay? Changes based on the type of report that you are making. If it's audit, it's different. If it's review, it's different. So there are two types of assurance, okay? International framework for assurance only provides two types. One is known as positive, reasonable, the other one is known as limited assurance. Positive means reporting accountant, they conclude the subject matter. That means your financial statement conforms in all material aspect with identified suitable criteria. That suitable criteria could be your standard, accounting standard, financial reporting standard, right? The report express positive assurance. This is the difference between reasonable and limited assurance. They provide positive assurance, such as when they are giving an opinion on the subject matter. Okay, they say that this is free from material misstatement or this is not free from material misstatement according to their opinion. When it comes to limited assurance, it's a negative assurance. Okay, just check the difference with the reasonable and limited. Wordings are same, but there are some differences. Here, they conclude that the subject matter is plausible in the circumstances. Okay, so example of negative assurances: procedures have not identified any material misstatement regarding the subject matter. Okay, so for example, if I ask you what's your name, you tell my name is so so so. It's a positive statement you're making. Negative statement would be my name is not this. That's a negative statement you're making. So same way. Now, reporting. What do you need to report? Title. This reporting is not for audit. This reporting is for review and other audit services. Okay. Here also we have title, addressee, identification, description of the subject matter, identification of the criteria, description of any inherent limitations, restriction on the use of the report to specific user. Okay. This type of report is not for general public. It's for specific users only. Statement of responsibilities of responsible party and the practitioner. Okay, the one who has been doing the review, that is known as the practitioner, and the responsible party is the one who is preparing it, the financial statement. Statement that the engagement was performed in accordance with professional standard. Remember, even if this is not audit, still when you are reviewing also, the financial statement needs to be performed in accordance with professional standard. Okay, you need to perform with professional standard when you are reviewing also, not just for auditing. Summary of the work performed. Practitioner's conclusion. Here also you need to give a conclusion, not modified or unmodified opinion, but conclusion. What is it? Date, name of the firm of practitioner, and location. So that's it for today. See you in day 3. We'll be covering the other 6 topics. So you can contact me on LinkedIn, Facebook, email, and Instagram for any doubts. So best of luck and see you tomorrow.